Before we dive in, please remember that this presentation is for informational and educational purposes only. I am not a licensed financial advisor or insurance agent, and the information provided in this video should not be considered legal or financial advice. Auto insurance policies can vary significantly between states and providers. It is crucial that you consult with a qualified and licensed insurance professional to discuss your specific needs and to review your own policy documents. You wake up one morning, grab your coffee, and head out the door to go to work. But you stop dead in your tracks. Overnight, a massive branch from that old oak tree in your front yard snapped off and landed directly on the roof of your car. The windshield is a spiderweb of cracked glass, and the roof is caved in like a crushed soda can. Your heart sinks. But then a small sense of relief. Thank goodness, you think, I have full coverage. You pull out your phone, call your insurance company, and confidently explain what happened. And then you hear the 5 words that every car owner dreads. We're sorry, that's not covered. How? How is that even possible? You pay hundreds of dollars every single month for what you believed was full coverage insurance. You've been a loyal customer for years. Yet here you are, with a car that's undrivable and a bill that's going to be thousands of dollars, and your insurance company is telling you, tough luck. This exact nightmare scenario happens to thousands of Americans every single day. And it almost always boils down to a fundamental misunderstanding of the 2 most important and most confusing words in your entire auto policy: collision and comprehensive. The truth is, full coverage isn't actually an official insurance term. It's a marketing phrase, a piece of jargon that has led to an incredible amount of confusion, frustration, and financial pain. And that confusion is exactly what we are going to eliminate today. In this video, I am going to pull back the curtain and demystify collision and comprehensive insurance once and for all. We're not going to use confusing industry jargon. We're going to use simple, real-world examples that you can actually relate to. By the time you finish watching, you will know with absolute certainty what you are paying for, what you are not paying for, and how to analyze your own policy to make sure you have the exact protection you need for your vehicle, without wasting a single dollar on coverage that doesn't make sense for you. Getting this wrong isn't a small mistake. It's the kind of mistake that can financially cripple you. Imagine still owing $10,000 on a car loan for a car that is now a worthless pile of metal in your driveway. Imagine having to drain your savings account, or worse, go into debt just to get a down payment for another car so you can get to work and feed your family. This is the reality for people who don't understand the fundamental difference between these 2 coverages. So let's fix that. Right now, let's start with collision. The name itself gives you a pretty big clue. If you had to boil collision coverage down to one single idea, it's this: collision pays to repair or replace your car after it is damaged in a collision with another object, or if it overturns. The key phrase there is collision with another object. This is your I hit something coverage. Let me give you some crystal clear examples. You're driving in stop-and-go traffic, you glance down at your phone for just a second and bam, you rear-end the car in front of you. The other driver's car is damaged, and your car's front end is completely smashed in. Your liability insurance, which is required by law in most states, will pay to fix the other driver's car. But what about your car? That's where collision coverage kicks in. Without it, you are paying for those repairs entirely out of your own pocket. Here's another one. You're backing out of a tight spot in a crowded mall parking lot. You misjudge the distance and crunch your rear bumper into one of those concrete light poles. That's a collision. Your collision coverage would pay to fix your bumper. Or maybe you're driving on a country road, a deer jumps out, you swerve to miss it, and you end up hitting a guardrail instead. Hitting the guardrail is a collision. Your collision coverage is what pays for those repairs. One more. You're driving in the winter, you hit a patch of black ice, lose control, and slide off the road into a ditch, hitting a tree. This is a single car accident. There's no one else to blame. No one else's insurance to file a claim against. This is a classic example of when your own collision coverage becomes your financial lifeline. Notice the pattern here? In all of these cases, your car was damaged because it physically collided with something, whether it was another car, a pole, a guardrail, or a tree. And in most of these scenarios, the accident was considered your fault. This is the primary purpose of collision insurance: to protect your financial investment in your own vehicle when you are at fault in an accident. It also covers you in a hit and run, where another driver hits you and flees the scene, leaving you with no one else to hold responsible. Without collision, you'd be stuck with the entire bill. So, to put it simply, collision equals crashing. If your car is damaged because you hit something, you'll be looking at your collision coverage. Now let's talk about the other side of the coin, comprehensive. This is where that tree branch story from the beginning comes in. If collision is the "I hit something" coverage, you can think of comprehensive as the "something else happened to my car" coverage. It's sometimes called other than collision coverage, which is a perfect description. It covers damage to your car from a whole list of unfortunate events that are not a collision. Think of comprehensive as your protection against bad luck, Mother Nature, and crime. Let's run through the real-world examples. That tree branch falling on your car? That is a classic comprehensive claim. Your car didn't collide with the tree. An external force, in this case gravity and a weak branch, damaged your vehicle. You're driving home from work and get caught in a severe thunderstorm. The sky opens up and golf ball-sized hail starts hammering down on your car, leaving dozens of dents all over your hood, roof, and trunk. That's not a collision. That's weather. That's a comprehensive claim. Now remember that deer example? I said if you swerve to miss the deer and hit a guardrail, that's a collision claim. But what if you don't swerve? What if you can't react in time and you hit the deer? This is one of the most confusing exceptions for people, but hitting an animal is not considered a collision. It falls under your comprehensive coverage. It's a bizarre rule, but it's a critical one to know. Hitting a live animal is comprehensive. Hitting a guardrail is collision. What if you walk out to your car in a parking lot and find that someone has smashed your window and stolen your stereo? Or just maliciously keyed the paint down the entire side of the door? That's vandalism and theft. That's a comprehensive claim. What if your car catches fire due to a mechanical problem? Or what if you live in an area prone to flooding, and your car is damaged by rising water? Fire and flood are also covered under comprehensive. So let's create a super simple mental shortcut. Collision equals your car hits an object. Comprehensive equals something happens to your car. Collision is for crashes. Comprehensive is for chaos, vandalism, theft, fire, flood, hail, falling objects, and hitting an animal. It's all the random, unpredictable stuff that life can throw at your vehicle when it's just sitting there, or when you're just driving along. Understanding this fundamental split is the first, most critical step to being an empowered car owner. You now know that when an insurance company talks about full coverage, what they are really talking about is a policy that includes three main parts. Liability, which is for damage you do to others, collision, which is for damage to your car from a crash, and comprehensive, which is for damage to your car from almost everything else. So let's break those last two down, because this is where the confusion really sets in for most people. Think of collision and comprehensive as two different shields that protect your car. They work together, but they defend against completely different kinds of attacks. Let's start with collision. The name says it all. This coverage is for when your vehicle collides with something. It could be another car, a telephone pole, a guardrail, a fire hydrant, or even the wall of your own garage. If you are behind the wheel and your car makes an impact, collision coverage is what steps in to pay for the repairs to your vehicle. This is a critical point. Your liability insurance, which is required by law in nearly every state, pays for the damage you do to other people and their property. It does absolutely nothing for your own car. If you only have liability insurance and you cause an accident, you'll get a check for $0 to fix your crumpled fender. You're on your own. Collision is the coverage you buy for yourself. And here's the most important thing to understand about collision coverage. It pays out regardless of who is at fault. Let that sink in for a moment. It doesn't matter if you were the one who zoned out and rear-ended someone at a red light, or if someone else ran a stop sign and T-boned you. In either scenario, you can file a claim under your own collision policy to get your car fixed. Now you might be thinking, wait a minute, if the other driver was at fault, shouldn't their liability insurance pay for my car? And the answer is yes, absolutely. In a perfect world, that's exactly how it works. Their insurance company accepts fault, processes the claim, and cuts you a check. But we don't live in a perfect world. What if the other driver is uninsured? A shocking number of people are driving around without any insurance at all. What if they have the absolute bare minimum coverage required by the state, and the damage to your brand new SUV is way more than their policy limit? Or what if it's a hit and run? The other driver is long gone, and there's no insurance company to chase down. In all of those scenarios, your collision coverage becomes your financial superhero. You call your own insurance company, you file a claim, and you get your car repaired. Your insurance company will then often go after the at-fault driver or their insurer to get that money back. A process called subrogation, but you don't have to wait for that to happen. You get your car back on the road quickly, without having to fight a legal battle or drain your savings account. This is the hidden power of collision coverage. It's a safety net for the unpredictable and irresponsible actions of others. So how does it actually work in practice? Let's say you have collision coverage with a $1,000 deductible. The deductible is the part of the bill you agree to pay yourself before the insurance company pays a dime. It's your skin in the game. One day you're backing out of a tight parking spot. You misjudge the distance, and you hear that gut-wrenching crunch of your bumper hitting a concrete pillar. You get an estimate from the body shop and it's going to cost $4,000 to fix. With your $1,000 deductible, you pay the first $1,000, and your insurance company pays the remaining $3,000. If you had chosen a $500 deductible, you'd pay $500 and they'd pay $3,500. The trade-off is simple. A lower deductible means you pay less out of pocket when you have a claim, but you pay a higher premium every month. A higher deductible means your monthly bill is cheaper, but you'll have to cough up more cash if an accident happens. Now there's another crucial term you need to know. Actual cash value, or ACV. This is what your car is worth the moment right before the crash. It is not what you paid for it. It's not what a new one would cost. It's the original price minus depreciation. The loss in value due to age, mileage, and wear and tear. Think of it like a smartphone. You might have paid $1,200 for the latest iPhone 3 years ago, but today you'd be lucky to get $200 for it. Cars are the same, just on a bigger scale. Your insurance company will only pay to repair your car up to its actual cash value. If your 10-year-old car is only worth $3,000, but the damage from the accident is $5,000, they're not going to pay for the $5,000 repair. At that point, they declare the car a total loss. They'll write you a check for the actual cash value. In this case, $3,000 minus your deductible, and they'll take possession of your wrecked car. This is a huge point of frustration for people, but it's a fundamental principle of insurance. They are there to restore you to the financial position you were in a second before the loss, not to put you in a better one. So, to recap, collision. It's for damage to your car from an impact with an object or another vehicle. It works regardless of who's at fault, and it pays for repairs up to your car's actual cash value, minus your deductible. It is your shield against the chaos of the road. But what about the chaos that comes from everywhere else? What about the threats that aren't another car or a pole? This is where collision's less understood, but equally important sibling comes in: comprehensive coverage. If collision is for crashing, comprehensive is for, well, almost everything else. The official industry term is other than collision coverage, which is actually a perfect description. It's the catch-all for the bizarre, the random, the acts of God that can damage or destroy your car. Imagine you're driving down a country road at dusk, and a deer leaps out in front of you. You hit it. Is that a collision? Your car collided with the deer, right? Logically, yes. But in the world of insurance, this is a classic comprehensive claim. Hitting an animal falls under comprehensive. Let's run through some other common scenarios. A freak hailstorm rolls through town and leaves your car looking like a golf ball. That's a comprehensive claim. You're parked under a big oak tree during a windstorm, and a massive branch snaps off and crushes your roof. Comprehensive. You come out of the grocery store to find someone has maliciously keyed your car from end to end. Vandalism. That's comprehensive. You wake up one morning and your car is just gone, stolen from your driveway. Comprehensive coverage is what pays you the actual cash value of your car so you can go buy a new one. Fire, floods, earthquakes, riots, a rock kicked up by a truck on the highway that cracks your windshield. All of these are typically covered by comprehensive. Like collision, you have a deductible that you have to pay first. And like collision, the payout is limited to the actual cash value of your vehicle. But the key difference is the source of the damage. Collision is about impact and movement. Comprehensive is about the weird stuff. It's your shield against nature, criminals, and pure bad luck. It's also important to know what comprehensive is not. The name comprehensive is a bit misleading. It sounds like it covers everything, but it doesn't. It will not cover mechanical failures like your transmission giving out. It won't cover routine maintenance like new tires or oil changes. And, most importantly, it will not cover damage from a collision. If you swerve to avoid the deer and hit a tree instead, that flips the claim from a comprehensive one to a collision one. The initiating event, the deer, is comprehensive, but the resulting damage, hitting the tree, is a collision. It's a subtle but critical distinction that can sometimes confuse people. So why are these two coverages, collision and comprehensive, almost always sold together? Why do you hear them spoken in the same breath? The biggest reason is financing. If you have a loan or a lease on your car, The bank or finance company technically owns it until you've paid it off. The car is their collateral for the loan. They have a vested financial interest in making sure that car is protected from every conceivable threat. They don't want you to crash the car, be unable to afford repairs, and then stop making payments on a worthless pile of metal. So, to protect their investment, they will almost universally require you to carry both collision and comprehensive coverage for the entire life of the loan. It's not optional. Once you own the car outright, the choice becomes yours. And when people say they have full coverage, this is what they're talking about. It's not an official insurance product. You can't call an agent and say, "Give me one full coverage." It's just street slang for a policy that bundles the three main components we've talked about: liability to protect others, and then collision and comprehensive to protect yourself. So let's break down those two pieces, collision and comprehensive, because this is where most of the confusion, and honestly most of the cost, comes from. These are the coverages that protect your investment, your vehicle. They are almost always sold together, but they are two completely separate things that protect you from completely different kinds of disasters. Let's start with collision. The name itself gives you a huge clue. Collision coverage is designed to pay for the repair or replacement of your vehicle when it is damaged in a collision. Simple, right? But what counts as a collision? It's broader than you might think. The most obvious example is hitting another car. You're driving through an intersection. Someone runs a red light and T-bones you. The damage to your car? That's what collision coverage is for. Or let's flip it. You're texting and driving, don't do that, and you rear-end the car in front of you. You are 100% at fault. Your liability coverage, as we discussed, will pay for the damage to the other person's car. But what about your crumpled front end? Your shattered headlights? That's where your own collision coverage steps in to fix your car, even when the accident was your fault. This is a critical point that so many people miss. Collision coverage works for you regardless of who is at fault. It's your safety net for your own vehicle in an accident. But it's not just about hitting other cars. Collision coverage also applies when you collide with an object. Think about sliding on an icy road and hitting a guardrail, or misjudging a turn in a parking garage and scraping a concrete pillar, backing out of your driveway and hitting your own mailbox. Even hitting a massive, vehicle-destroying pothole can be considered a collision in the eyes of your insurance company. If your car collides with something, anything, and gets damaged, this is the coverage that comes to the rescue. It also covers single-car accidents where your vehicle flips or rolls over, which is technically a collision with the ground. Now, here's the most important part of collision coverage you need to understand: the deductible. The deductible is the single biggest lever you can pull to control the cost of your insurance. A deductible is simply the amount of money you agree to pay out of pocket for a repair before the insurance company starts paying. Think of it as your share of the cost. Let's imagine you have a collision policy with a $1,000 deductible. You get into that accident we talked about, and the body shop quotes the repair at $5,000. You are responsible for the first $1,000. You pay that directly to the body shop. Once you've paid your part, your insurance company steps in and pays the remaining $4,000. If the damage was only $800, you'd pay the full amount yourself, and you wouldn't even file a claim because the cost of the repair is less than your deductible. Deductibles typically range from $250 all the way up to $2,500. And here's the golden rule: the higher your deductible, the lower your premium will be. Why? Because by choosing a higher deductible, you are telling the insurance company, "I'm willing to take on more financial risk myself in the event of a small accident." This makes you less of a risk to them, so they reward you with a lower price for the coverage. Conversely, a low deductible like $250 means the insurance company is on the hook for almost everything, which makes you a higher risk to insure, so they charge you a higher premium. There's no right or wrong answer here. It's a personal financial decision. You have to ask yourself, how much cash could I comfortably come up with tomorrow if I had to get my car fixed? That answer is a good starting point for choosing your deductible. But what happens if the damage is really, really bad? What if the cost to repair your car is more than the car is actually worth? This is when the insurance company will declare your car a total loss, or what people commonly call totaled. This is another area packed with misconceptions. When your car is declared a total loss, the insurance company is not going to pay to fix it. Instead, they are going to write you a check for the car's actual cash value, or ACV. This is the key phrase: actual cash value. This is not what you paid for the car. It's not what you think it's worth. And it's definitely not what it would cost to buy a brand new one. The actual cash value is what your exact car, with its specific year, make, model, mileage, options, and condition, was worth in the open market the second before the crash happened. Insurance companies use sophisticated market data from sources like Kelley Blue Book, NADA guides, and local sales listings to determine this value. They look at what similar cars have recently sold for in your area. So if your 5-year-old sedan with 80,000 miles was worth $10,000 right before the accident, that's the ACV. Now here's how the payout works. They take that actual cash value, and they subtract your deductible. So if the ACV is $10,000 and you have that $1,000 deductible, you will receive a check for $9,000. It's crucial to remember this. Your deductible applies even if your car is a total loss. And what happens to your wrecked car? The insurance company takes it. You don't get to keep the car and get the check. The moment they pay you for its value, the salvage, the wrecked vehicle itself, belongs to them. They will then typically sell it for parts or scrap at an auction to recoup some of their loss. This can be a really painful process, especially if you have a loan on the car. If you owe the bank $12,000, but the ACV is only $10,000, that $9,000 check from the insurance company won't be enough to pay off your loan. You'll still owe the bank $3,000 for a car you can no longer drive. That difference is called being upside down or having negative equity. And there's a separate type of insurance for that called gap insurance, which is a topic for another day. So to recap, collision. It covers damage to your car from an impact with another vehicle or an object, regardless of who is at fault. The payout is subject to your deductible, and if the car is totaled, you get its actual cash value, minus that deductible. It's your shield against the financial devastation of a car crash. It's a powerful and essential coverage for anyone with a car they can't afford to simply replace with cash. But it has very specific limits. It only covers collisions. So what happens when something else damages your car? Something that has nothing to do with hitting another object. Imagine you wake up one morning, walk outside with your coffee, and you see a massive tree limb has fallen on your car overnight, shattering your windshield and caving in your roof. Or a hailstorm rolls through town and leaves your car looking like a golf ball. Or you're driving down a country road and a deer leaps out in front of you. You hit the deer, causing thousands in damage. In each of these cases, you didn't collide with another car or a stationary object in the traditional sense. Tree fell on you. Hail fell on you. An animal ran into you. You might call your agent thinking, "Thank God I have collision coverage." But the agent will have to tell you, "I'm sorry, but none of that is covered by your collision policy. For that, you need its partner. Comprehensive. Comprehensive coverage is the other half of the coin. If collision is the shield that protects your car in a crash, comprehensive is the force field that protects it from, well, pretty much everything else. Think of it this way, collision is for when your car hits something. Comprehensive is for when life hits your car. It's also known as other than collision coverage, which is a bit bland, but perfectly descriptive. It's the policy that steps in when the damage has nothing to do with you colliding with another vehicle or object. It's for the random, the unpredictable, the chaotic acts of nature and humanity. Let me tell you about Sarah. Sarah just bought her first brand new car. A beautiful deep blue sedan she'd been saving for since she graduated college. It was her baby. She named it Blue. She parked it at the far end of every parking lot, away from stray shopping carts and clumsy door dingers. She washed it by hand every Sunday. She even bought one of those little trash cans for the interior. She was meticulous. When she bought her insurance, she knew she needed full coverage because of her car loan, so she got a policy with liability, collision, and comprehensive. She didn't really think about the difference, they were just line items on a bill she had to pay. One Tuesday in July, Sarah was at her office. It was a perfect summer afternoon, sunny, warm, a few fluffy white clouds in the sky. She was in a meeting staring out the window when the sky started to change. The clouds turned from fluffy white to a bruised, angry purple in a matter of minutes. The wind picked up, rattling the windows of the high-rise. Then came the sound, a soft patter at first, then a loud, aggressive drumming. Rain. Then a sharp crack against the glass. And another. And another. It was hail. Not little pellets of ice. These were chunks. Golf ball-sized, then baseball-sized monsters hammering the world outside. Everyone in the office rushed to the windows, a mix of awe and horror on their faces. But all Sarah could feel was a cold, sinking dread. Her new car, Blue, sitting completely exposed in the middle of the employee parking lot. She could only watch as the storm unleashed its fury for 10 brutal minutes. When it was over, The sun came back out as if nothing had happened. But the damage was done. She ran down to the parking lot, her heart pounding in her chest. The sight was sickening. Her beautiful, pristine car looked like it had been beaten with 1,000 tiny hammers. The hood, the roof, the trunk. Every single metal surface was covered in a constellation of deep, ugly dents. The windshield had a spiderweb of cracks spreading from a massive impact point. Her baby was destroyed. She leaned against the driver's side door, the only part of the car that was miraculously unscathed, and just felt numb. All that saving, all that care, wiped out in 10 minutes by frozen water falling from the sky. Fighting back tears, she pulled out her phone and called her insurance company. When the agent answered, Sarah's voice trembled. "My car, there was a hailstorm, it's ruined." She braced herself for the worst. She remembered the term collision. This wasn't a collision. She didn't hit anything. Nothing hit her, not really. Was this some loophole? Some fine print she missed? Was she about to be on the hook for thousands, maybe tens of thousands of dollars in repairs on a car she still owed money on? The agent on the other end was calm. "Okay, Sarah, take a deep breath. I know this is upsetting. Are you safe?" She confirmed she was. "Good," the agent said. "Now tell me, do you have comprehensive coverage on your policy?" Sarah's mind raced. She thought so. "Yes, think so. It's full coverage." The agent's voice was reassuring. "Then you have nothing to worry about. This is exactly what comprehensive coverage is for." A wave of relief so powerful it almost made her dizzy washed over Sarah. The agent explained that hail damage is a classic comprehensive claim. It's damage from something other than collision. He told her to take pictures, get a repair estimate from a body shop that specializes in paintless dent repair, and file the claim through their app. Her responsibility would be her comprehensive deductible, which was $500. The insurance company would cover the rest. The final bill for the repairs came to over $8,000. Sarah paid her $500, and her insurance paid the other $7,500. Her car was returned to her looking brand new, as if the storm had never happened. That day, comprehensive stopped being just a line item on her bill. It became the safety net that caught her when the sky literally fell. Sarah's story is the perfect illustration, but comprehensive covers so much more than just hail. It's a surprisingly broad category of protection. Let's break down the big ones. First, and most obviously, weather and natural disasters. We're talking hail, floods, windstorms, tornadoes, hurricanes, and even earthquakes. If a tree branch falls on your car during a storm, that's a comprehensive claim. If your car is submerged in a flash flood, that's comprehensive. Second, it covers theft. This is a huge one. If your car is stolen and never recovered, your comprehensive coverage will pay you the actual cash value, or ACV, of your vehicle, minus your deductible. It also covers damage from an attempted theft. So if a thief breaks your window and smashes your ignition trying to hotwire the car but fails to steal it, the repairs for that damage fall under comprehensive. Third, it covers vandalism and civil unrest. Someone keys your car in a parking lot? Comprehensive. Someone slashes your tires out of spite? Comprehensive. Your car is damaged during a riot or protest. That's also covered by comprehensive. Fourth, it covers fire. Whether it's an engine fire due to a mechanical failure, or your car was parked in a garage that caught fire, the damage is handled by your comprehensive policy. And this brings us back to where we started. Animal collisions. Hitting a deer, a bear, a dog, a moose, any animal, wild or domestic, is considered a comprehensive claim, not a collision claim. This is the single biggest point of confusion for most people. The logic from the insurance industry's perspective is that the animal is an unpredictable, unavoidable hazard. You didn't fail to control your vehicle and collide with an object. An external force, the animal, essentially collided with you. It's treated more like a falling object than a typical crash. So if you swerve to avoid the deer and hit a guardrail instead, that's a collision claim. But if you hit the deer directly, that's a comprehensive claim. It's a strange but critical distinction to understand. It also covers falling objects. This could be a rock kicked up by a truck on the highway that cracks your windshield. It could be a piece of ice sliding off a roof in the winter. It could be debris falling from an overpass. Anything that falls onto your car and causes damage is covered. You might hear people lump all of this under the term act of God. While that's a common phrase, it's not actually an official insurance term. Insurance policies are very specific. They don't just say acts of God are covered. They list specific perils like hail, flood, wind, and falling objects. Comprehensive is the policy that covers most of those named perils. Just like collision coverage, comprehensive coverage has a deductible. This is the amount you pay out of pocket before the insurance company pays the rest. Deductibles can range from $0 to $2,000 or more. One thing you'll often find is that people choose a lower deductible for their comprehensive coverage than for their collision coverage. For example, you might have a $1,000 collision deductible, but only a $250 comprehensive deductible. Why? Because comprehensive claims are generally seen as not your fault. You didn't cause the hailstorm. You didn't ask the deer to jump in front of your car. Because there's no fault assigned, these claims typically don't raise your rates, and people feel more comfortable paying a slightly higher premium for a lower out-of-pocket cost on these bad luck events. Now, is comprehensive coverage legally required? No. Just like collision, no state law mandates that you carry comprehensive insurance. However, if you have a loan or a lease on your vehicle, your lender will almost certainly require you to have it. The bank or finance company is a part owner of your car until it's paid off. They have a financial interest to protect. They want to ensure their asset, your car, is protected not just from crashes, but from theft, fire, floods, and everything else. Once your car is paid off, the choice to keep comprehensive coverage is entirely up to you. So collision covers crashes. Comprehensive covers chaos. One protects you from the predictable dangers of the road, the other from the unpredictable dangers of the world. They are two distinct forms of protection that work together to shield the value of your vehicle. But this brings us to the most important question of all. Now that we know what they are, how do you know if you actually need them? And if you do, how do you choose the right deductible? Is there a point where paying for this coverage is just a waste of money? The answer is yes. And there's a simple formula you can use to figure it out for your exact car and your exact financial situation. Let's start with that formula. It's called the break-even calculation, and it's shockingly simple. It tells you exactly how many years you need to go without a claim for a higher deductible to be the financially brilliant choice. Here's how it works. First, you need two quotes from your insurance company. One with a low deductible, say $500, and one with a high deductible like $1,000 or even $2,000. You're going to do this for both your collision and your comprehensive coverage, because the math might tell you to do different things for each one. Step 1. Calculate your annual premium savings. This is the difference in price between the high deductible plan and the low deductible plan. Let's say a policy with a $500 collision deductible costs you $600 a year for just the collision part, and a policy with a $1,000 deductible costs you $450 a year. Your annual savings are $150. That's cash you get to keep in your pocket every single year. Step 2. Calculate the difference in the deductible. This is easy. $1,000 minus $500 is $500. This is the extra risk you're taking on. If you crash, you'll have to pay an extra $500 out of pocket. Now for the magic. Step 3. Divide the extra risk by your annual savings. In our example, that's $500 of extra risk, divided by $150 of annual savings. The answer is 3.33. What does that number mean? It's the number of years it will take for your savings to pay for the extra risk you took on. It is your break-even point. If you can go more than 3.33 years without an at-fault accident, you come out ahead. You've officially beaten the insurance company's pricing model. Every year after that is pure profit straight into your savings account. If you tend to get into accidents more frequently than every 3.33 years, then the lower deductible is the smarter bet for you. You're essentially paying the insurance company a fee to protect you from your own driving habits. This formula turns a gut feeling into a mathematical certainty. But the math is only half the story. The other half is you. You have to honestly assess two things: your personal risk factor and your financial cushion. Let's start with your risk. Are you a 19-year-old in a Dodge Charger who parallel parks in downtown Boston every day? Your risk of a collision claim is astronomically high. Or are you a 45-year-old who works from home and drives a minivan 3 miles to the grocery store once a week in a quiet suburb? Your risk is incredibly low. Be honest with yourself. Look at your driving record. How many tickets or accidents have you had in the last 5 years? Do you drive during rush hour? Do you live in an area with a lot of deer? Or frequent hailstorms? Does your teenager who still thinks a yellow light means go faster also drive the car? All of these things dramatically change your probability of filing a claim and should influence your decision. A 3.33-year break-even point might seem like a great bet for the suburban minivan driver. but a terrible one for the city-dwelling muscle car owner. Now for the second and arguably more important factor, your financial cushion. The break-even formula is great, but it assumes you can actually afford the higher deductible if something bad happens. So ask yourself this brutally honest question. If I had to write a check for $1,000 or $2,000 tomorrow to get my car out of the shop, could I do it without breaking a sweat? Would it mean I couldn't pay rent? Would I have to put it on a high-interest credit card? If a surprise $1,000 bill would be a genuine financial crisis for you, then a higher deductible is a terrible idea, no matter what the math says. In this case, think of a lower deductible as buying peace of mind. You're paying a little more each year, that $150 in our example, for the ironclad guarantee that a single bad day won't derail your entire budget. There is absolutely no shame in that. It's a smart, defensive financial move. But if you have a healthy emergency fund, and a $1,000 expense is just an annoyance, not a catastrophe, then you have the financial strength to take that risk and save money in the long run. And remember, you have to run this calculation separately for comprehensive. The numbers are often wildly different. Let's say for comprehensive, a $250 deductible costs you $150 a year. But a $500 deductible only drops the price to $120 a year. Your annual savings are just $30. The deductible difference is $250. So 250 divided by 30, that's an 8.33-year break-even point. You'd have to go over 8 years without a single non-collision incident. No cracked windshields, no hail damage, no deer strikes, no theft, to make the higher deductible worth it. For most people, that's a bad bet. The tiny $30 annual savings just isn't worth the risk of a much larger bill. This is why you'll often see people with a high collision deductible like $1,000, but a much lower comprehensive deductible, like $250 or even $0 glass coverage. Okay, so that's how you choose the right deductible. But this leads to the ultimate question. When should you get rid of collision and comprehensive coverage entirely? When is paying for it at all just throwing money away? There's a fantastic rule of thumb for this, and it's called the 10% rule. It's very simple. If the total annual cost of your collision and comprehensive premiums is more than 10% of your car's actual cash value, it's time to seriously consider dropping them. Here's how it works in the real world. Let's say you're driving a trusty 12-year-old Toyota Camry. You look it up on Kelley Blue Book and find out its private party value is about $5,000. That's its actual cash value, or ACV. 10% of $5,000 is $500. Now you pull up your insurance declaration page. You see you're paying $400 a year for collision and $200 a year for comprehensive. Your total cost is $600 a year. Since $600 is more than your $500 threshold, 10% of your car's value, the 10% rule screams that you should consider dropping the coverage. Why? Let's break down the cold, hard logic. You are paying $600 every year to protect a car that's worth $5,000. But wait, it's actually worse than that. If you total your car, the insurance company doesn't just hand you a $5,000 check. They hand you $5,000 minus your deductible. If you have a $1,000 deductible, the maximum possible payout you could ever receive is $4,000. So you are paying $600 per year to protect a potential $4,000 payout. Think about that. If you go just over 6.5 years without a major accident, you will have paid the insurance company more in premiums than they would ever pay you in a total loss claim. You're guaranteeing a loss. You would have been better off taking that $600 every year, sticking it in a high-yield savings account labeled New Car Fund, and just accepting the risk yourself. This is what financial advisors mean when they talk about self-insuring. You're not being reckless. You're making a calculated decision to manage the risk yourself because the cost of transferring that risk to an insurance company has become too high. You're playing the odds, and the odds are now firmly in your favor. Now there is one giant, unmissable caveat to all of this. If you have a loan or a lease on your car, you can't drop this coverage. The bank or leasing company that technically owns your car requires you to maintain full coverage to protect their asset. It's not your choice. The 10% rule only applies to cars that you own outright. Once you send in that final payment and get the title in your name, you are free to make this decision for yourself. But that freedom comes with a massive question. A financial tightrope walk that can either save you thousands of dollars or cost you everything in an instant. The question is, what should your deductible be? And this is where most people get it completely wrong. They see the deductible as just one number on a page, a minor detail. They don't realize it's the single most powerful lever you can pull to control your insurance costs and your financial risk. Let's break this down. A deductible is simply the amount of money you have to pay out of your own pocket for a repair before your insurance company pays a single dime. Think of it like a cover charge at a club. You have to pay the bouncer your deductible before you're allowed inside where the insurance company's money is. If the damage to your car is less than your deductible, you're on your own. The insurance company won't even look at your claim. Now here is the critical multi-thousand-dollar mistake that millions of drivers make. They assume they have one deductible. They don't. You have a separate deductible for collision and a separate deductible for comprehensive. And yes, you can get hit with both in a very short period of time. Let me paint you a picture. Meet Alex. Alex is having a terrible week. On Monday, a freak windstorm rips through his neighborhood and a massive oak branch snaps off, crushing the hood and windshield of his parked car. The body shop quotes him $4,000 for the repair. Alex sighs but thinks, okay, at least I have insurance. This is a comprehensive claim, an act of God not related to driving. Alex has a $500 comprehensive deductible, so he pays the first $500, and his insurance company covers the remaining $3,500. He's annoyed, but his car is getting fixed. Fast forward to Friday. Alex gets his car back from the shop. It looks brand new. He's feeling better. He heads to the grocery store, but he's distracted, still thinking about the crazy week. He misjudges the distance to a concrete pillar in the parking garage and backs right into it, leaving a nasty dent and scraped down the entire rear quarter panel. The new quote? Another $2,500. This time it's a collision claim. He collided with an object. Alex has a $1,000 collision deductible, so now he has to pay another $1,000 out of his own pocket before his insurance covers the remaining $1,500. In less than 1 week, Alex, who thought he was fully covered, had to shell out $1,500 of his own money, $500 for the first claim, and $1,000 for the second. He paid 2 separate cover charges to get into the club. This is the reality. Your deductibles are separate, and they can stack up with a string of bad luck. Understanding this opens up a strategic choice. The deductible dilemma. Should you choose a low deductible or a high one? A low deductible, say $250 or $500, feels safe. Gives you peace of mind. You know that no matter what happens, your maximum out-of-pocket for any single incident is a manageable amount. The trade-off? Your monthly premium will be significantly higher. You are paying the insurance company more every single month for that security blanket. Over years of safe driving, you could be paying thousands of extra dollars for a benefit you never use. On the other side of the coin is a high deductible, $1,000, $1,500, or even $2,000. This is the path for the financially disciplined. The immediate benefit is a much lower monthly premium. You could save anywhere from $30 to $60 a month, maybe more. That's hundreds, even over $1,000 a year back in your pocket. But you are taking on more risk. You are essentially telling the insurance company, I'll handle the small stuff. I'll self-insure for the first $2,000 of damage. I only need you for a catastrophe. This is a brilliant financial move if, and only if, you actually take the money you're saving on premiums and put it into a dedicated emergency fund. Let's look at 2 drivers. First, there's Sarah. Sarah's cautious. She has a young family and a tight budget. The thought of a sudden $2,000 bill gives her anxiety. She chooses a $500 deductible for both collision and comprehensive. Her premium is $160 a month. She sleeps well at night knowing her exposure is low. Then there's Ben. Ben is a confident, safe driver with a healthy emergency fund. He sees the math. He opts for a $2,000 deductible on both coverages. His premium drops to just $100 a month. He saves $60 every single month compared to Sarah. He sets up an automatic transfer and puts that $60 into a high-yield savings account he labels car insurance deductible. For 3 straight years, both Sarah and Ben are accident-free. Sarah has paid $5,760 in premiums. Ben has paid $3,600. He has also accumulated over $2,160, plus interest, in his dedicated savings account. He is more than $2,000 ahead of Sarah. In year 4, they both have a bad day. Sarah gets into a fender bender that costs $3,000 to fix. She's stressed, but she writes a check for her $500 deductible, and the insurance handles the rest. She feels her higher premium was justified. Later that year, Ben hits a patch of black ice and slides into a guardrail, causing $6,000 in damage. It's a huge hit, But Ben is prepared. He calmly transfers the $2,000 from his car insurance deductible account to his checking account and pays the body shop. His insurance covers the other $4,000. Even after a major accident, Ben still has money left over in his special account, and he has still paid less overall than Sarah has. He used the insurance company's own pricing model against them. He took the discount they offered for taking on more risk, and he mitigated that risk himself. Now let's add another layer of strategy. Remember, you can set different deductibles for collision and comprehensive. And you should. Think about the risk. Comprehensive claims, theft, vandalism, fire, hitting an animal, weather are often things you have zero control over. They are statistically less frequent for most people than collision claims. So, a smart strategy many people use is to keep their comprehensive deductible relatively low, say $500. This protects you from a freak act of nature without costing a fortune in premiums. But for collision, which is directly related to your driving, you might bet on yourself. If you're a safe, defensive driver with a clean record, you might feel comfortable jacking that deductible up to $1,000 or $1,500 to get that big premium discount. You're essentially saying, I'm not going to cause an accident, so I want to pay less. I'll keep the comprehensive lower just in case a deer decides to redesign my front bumper. This level of customization is how you transform insurance from a frustrating expense into a strategic financial tool. But be warned, as you're making these choices, your agent might dangle a tempting offer in front of you, something called a vanishing deductible or deductible rewards. The sales pitch is seductive. For every year you go without a claim, we'll reduce your deductible by $100 until it drops all the way to zero. It sounds like a free reward for being a good driver. It is not free. It's an add-on, a rider to your policy that you pay extra for every month. The cost might seem small, maybe $5 or $6 a month. But do the math. $6 a month is $72 a year. So you're paying $72 to get a $100 reduction in your potential future deductible. If you go 5 years without a claim to get your deductible to zero, you've paid them $360 for a benefit you never used. You would have been far better off just putting that $6 a month into your own savings account. It's a gimmick designed to sound better than it actually is. So you've chosen your coverages. You've outsmarted the system and set your deductibles like a pro. You have your emergency fund ready. Then the worst happens. It's not a fender bender. It's a major crash. And a few days later, you get the call from the insurance adjuster. They utter the 3 words every car owner dreads. It's a total loss. Suddenly, your deductible is the least of your worries. Now, the fight is over the actual value of your car. And the number the insurance company gives you is almost always shockingly, insultingly low. It's a number that won't even cover what you still owe on the loan, let alone help you buy a replacement. This is the moment most people feel helpless and get taken advantage of. But you don't have to, because there is a secret weapon. 2 actually. The first one is designed specifically for that nightmare scenario where the insurance payout isn't enough to cover your loan. It's called gap insurance, TEPI, and it's one of the most misunderstood and yet most critical add-ons you can get, especially if you bought a new or nearly new car. Let's break it down with simple math. Imagine you buy a car for $30,000. You put a little money down and finance the rest. The second you drive it off the lot, it depreciates. It loses value. That's just a fact of life. A year later, you get into a wreck, and your car is declared a total loss. At this point, you still owe $24,000 on your loan. The problem is, the car is no longer worth $24,000. Because of depreciation, its actual cash value, the number your comprehensive or collision coverage will pay out, is only, let's say, $20,000. So the insurance company writes you a check for $20,000. That's great, but you still owe the bank $24,000. The insurance check goes straight to the lender, and you are still on the hook for the remaining $4,000. $4,000, for a car that is now a twisted heap of metal in a salvage yard. You are paying for a ghost. This difference, this canyon between what you owe and what the car is worth, is called the gap. And it's where gap insurance becomes your absolute hero. If you have gap coverage, it swoops in and pays that $4,000 difference directly to the lender. Your loan is wiped clean. You owe nothing. You can walk away from that totaled car with a clean slate, free to figure out your next move without a massive, soul-crushing debt hanging over your head for a vehicle you can't even drive anymore. It transforms a potential financial catastrophe into a manageable inconvenience. Now here is the multi-$1,000 secret that car dealerships really don't want you to know. When you're in that finance office buying your car, they will try to sell you gap insurance. They'll roll it into your loan, and they'll mark it up by an astronomical amount. They might charge you $700, $800, even over $1,000 for it. But you can call your own car insurance company the same day and add gap coverage to your policy for about $5 or $6 a month. We're talking $60 or $70 a year. Over the life of a loan, the dealership is charging you 10 times what your own insurer will. So rule number 1, always buy gap coverage from your insurance provider, not the dealership. But gap insurance only solves half the problem. It clears your debt. It doesn't put any cash in your pocket to buy a new car. That's where our second secret weapon comes in. This is how you fight back against that lowball offer for your car's value. This is how you challenge the insurance company and get what you're rightfully owed. You have to remember, the first offer the adjuster gives you is just that, an offer. It is not a final, non-negotiable decree from on high. It is a starting point in a negotiation. Their job is to settle the claim for the lowest amount possible. Your job is to not let them. The moment you get that lowball number, your work begins. First, you politely decline to accept the offer. You don't have to be rude, just firm. Say something like, "Thank you for putting that together for me. I'm going to need some time to review it, as it seems quite a bit lower than my research indicates for a replacement vehicle." This signals that you're not a pushover. Second, you become a detective. The insurance company used a third-party service to come up with their valuation. You need to ask for a copy of that valuation report. It will list the comparable vehicles, or comps, they use to determine your car's worth. This is your battlefield. You need to scrutinize their comps. Are they the same trim level as your car? Did they have the same options? Did they account for the premium sound system you had? The sunroof? The upgraded technology package? Often they don't. They'll compare your fully loaded limited model to a base model and claim they're the same. Your mission is to find your own comps. Go on AutoTrader, Cars.com, and local dealership websites. You're looking for cars that are the exact same year, make, and model as yours with similar mileage in the same general geographic area. Find listings for cars that are as close to a clone of your old car as possible. The key here is to look at the dealer asking price. Not the private party value, not the trade-in value, but what it would actually cost you today to go out and buy a comparable replacement car from a reputable dealer. Save screenshots. Save the links. You're building a portfolio of evidence. If you can find 3 to 5 listings that are priced significantly higher than the insurer's offer, you have a powerful case. Third, you need to document your car's life story. Did you just put a brand new set of Michelin tires on it a month before the accident? Find the receipt. That adds value. Did you have a religious maintenance schedule with oil changes every 5,000 miles on the dot? Show them the service records. A well-maintained car is worth more than a neglected one. Did you add a remote starter? A high-end roof rack? Any aftermarket improvements? Receipts, receipts, receipts. You need to paint a picture for the adjuster of a vehicle that was in pristine, above-average condition. Don't just tell them it was in great shape. Prove it. Once you have your evidence, your comparable vehicle listings, your maintenance records, your receipts for upgrades, you present it to the adjuster in a clear, organized, and professional manner. Send them an email with everything attached. Lay out your argument logically. The comps you used were for a base model, but my vehicle was the touring trim with the technology package. Here are 3 local listings for the same trim, and their average asking price is $4,000 higher than your offer. Additionally, I just invested $900 in new tires, for which I've attached the receipt. Based on this evidence, a fair actual cash value would be X. 9 times out of 10, when an adjuster is presented with a well-researched, evidence-based counteroffer, they will increase their settlement amount. They might not meet your number exactly, but they will come up, because you've demonstrated that their initial offer was not based in reality. You've done the work, and they know you're not going to just roll over. And if they still refuse to budge, if you're at a complete impasse and they're stonewalling you, you have one more card to play. It's the one they really don't want you to use. You can invoke the appraisal clause of your policy. Almost every auto insurance policy has one. It states that if you and the company can't agree on the value of the vehicle, you can both hire independent appraisers. You hire one, they hire one. Those 2 appraisers then work to agree on a value. If they can't agree, they mutually select a third appraiser, an umpire whose decision is binding. This process forces the issue and takes it out of the hands of the adjuster, who is trying to save the company money. Just the act of mentioning that you plan to invoke the appraisal clause is often enough to get them to come to the table with a much more reasonable offer, because they know it's going to cost them time and money to go through that process. This is how you turn the tables. You go from being a victim of circumstance to being an advocate for your own financial well-being. By understanding gap insurance, you protect yourself from debt. And by understanding how to negotiate the actual cash value, you fight for the money you need to get back on the road. These two strategies working in tandem are the difference between a total loss being a financial disaster and it being just a bump in the road. And it all hinges on having the right coverages, collision and comprehensive, in the first place. Without them, you have no claim to make, no offer to negotiate, and no foundation for gap coverage to even work. They are the gateway to making you whole again. But making you whole isn't the only cost to consider. There are other people involved in an accident too. Because when you're in a crash, it's not just about your car. It's about their car, their health, their livelihood. And for that, there is an entirely different type of coverage, one that is legally required in nearly every state. It's called liability insurance. And if collision and comprehensive are the shield that protects your car, liability is the fortress that protects your entire financial life. Liability coverage does nothing for your vehicle. Zero. You could have $1 million in liability coverage total your brand new car. And if you don't have collision, your liability coverage won't pay you a single penny for it. Why? Because liability is not for you. It's for them, the other people. It pays for the damage and injuries you cause to other drivers, passengers, and pedestrians. It's broken down into two main parts: property damage and bodily injury. Property damage liability is straightforward. You run a red light and smash into someone's new SUV? Your property damage coverage pays to repair or replace their vehicle. You swerve on ice and take out a homeowner's mailbox and a section of their fence? Your property damage coverage pays for that too. Bodily injury liability is where the stakes get astronomically higher. This covers the medical expenses, lost wages, and even pain and suffering for the people you injure in an at-fault accident. And this is where so many people unknowingly risk everything to save a few dollars a month. Let me tell you a story about a guy we'll call David. David is a good guy. A responsible 35-year-old accountant with a wife, a small house in the suburbs, and a decent savings account he's been building for years. Like many people, he shopped for car insurance based on one thing: the lowest price. He ended up with what's called state minimum liability coverage. In his state, that was $25,000 for bodily injury per person, $50,000 total for bodily injury per accident, and $25,000 for property damage. It's often written as 25/50/25. He felt smart. He was saving about $30 a month compared to higher limits. He's a safe driver, he thought. What could possibly happen? One Tuesday afternoon it happened. He was driving home from work, tired after a long day. His phone buzzed in the center console. A text from his wife. He glanced down for just 2 seconds. But in those 2 seconds, the car in front of him, a minivan, slammed on its brakes. By the time David looked up, it was too late. The sickening crunch of metal echoed through the intersection. His car was totaled, but that was the least of his problems. He had collision coverage, so he knew his car would be taken care of. The real nightmare was just beginning inside that minivan. There was a family of 4. The father, driving, suffered severe whiplash. The mother in the passenger seat had a broken arm and 2 fractured ribs. One of their children in the back had a concussion. Now let's do the math. The brutal, unforgiving math of an insurance claim. First, the property damage. The minivan was a newer model, valued at $42,000. David's state minimum property damage limit was $25,000. Right off the bat, his insurance pays out the max $25,000, and the family is still short $17,000 for their vehicle. Who pays that? David does. That's a $17,000 bill he is now personally responsible for. But that's nothing compared to the medical bills. The mother's injuries were the most severe. The ambulance ride, the emergency room, the surgery to set her arm with a plate and screws, the hospital stay, the follow-up appointments, the physical therapy. Her total medical bills came to $68,000. David's insurance policy had a per-person limit of $25,000. So his insurance company writes a check for $25,000 and says, "That's all we can do." The mother is now left with $43,000 in medical bills. The father's whiplash treatment, MRIs, and chiropractic care totaled $12,000. That's within the $25,000 per person limit, so his insurance covers it. The child's concussion treatment and monitoring costs $7,000. That's also covered. But remember the per-accident limit? David's was $50,000. His insurance paid $12,000 for the father and $7,000 for the child. That's $19,000. They then paid the $25,000 limit for the mother. The total they paid out for bodily injury was $19,000 plus $25,000 equals $44,000. This is under his $50,000 per accident limit. But the mother is still owed $43,000. Who pays that? David does. So let's tally it up. David is personally on the hook for $17,000 for the remainder of the car and $43,000 for the rest of the mother's medical bills. He is now facing a bill for $60,000. His entire savings account, the one he'd spent years building, wiped out in an instant. But it gets worse. We haven't even talked about lost wages. The mother couldn't work for 3 months. The father missed several weeks. And we haven't talked about the legal concept of pain and suffering. This is where the family's attorney comes in. They see that David's insurance is exhausted, and that their clients are still owed a massive amount of money. So they sue David. Personally, they sue him for the remaining medical bills, the remaining property damage, the months of lost income, and for the pain and trauma of the accident. The lawsuit isn't for $60,000. It's for $250,000. David's world implodes. The $30 a month he saved on insurance suddenly seems like the worst financial decision of his life. He has to hire a lawyer. The court case drags on. In the end, a judgment is entered against him. To satisfy it, his wages are garnished for the next decade. A lien is placed on his house, meaning if he ever sells it, the proceeds go to the family he hit. His credit is destroyed. His financial future, his family's security, all of it gone. Because of a 2-second glance at a text message and an insurance policy that was technically legal, but practically worthless in a serious accident. This is the catastrophic difference between collision and liability. Collision protects your car. Liability protects everything else you own and will ever earn. The state doesn't require you to carry liability insurance to protect you. They require it to provide at least a small minimal safety net for the victims you might create. The state minimum is not a recommendation. It is the absolute lowest legal bar you must clear to operate a vehicle. Thinking it's enough coverage is like thinking a smoke detector is a fire department. Now, imagine if David had spent that extra $30 a month. Instead of 25/50/25, he could have had limits of 100/300/100. 100,000 for bodily injury per person, 300,000 per accident, and 100,000 for property damage. In that scenario, what happens? The $42,000 minivan is completely covered by his $100,000 property damage limit. The $68,000 in medical bills for the mother are completely covered by his $100,000 per person limit. All the other medical bills are covered. The insurance company would have provided him with a lawyer as part of his policy, and they would have negotiated a settlement for lost wages and suffering, all paid for out of his ample coverage limits. David would still feel terrible. He would still have to get a new car. But his savings would be intact. His house would be safe. His future income would be his own. He would have paid his insurance company a premium to take on that $1 million risk for him. And in his moment of greatest need, they would have stepped in and done exactly that. He would have walked away from a life-altering catastrophe financially whole. Collision and comprehensive are critical for protecting the thousands of dollars you've invested in your vehicle. But liability coverage protects the hundreds of thousands, or even millions, of dollars that make up your financial life. One protects your asset, the other protects your future. But what happens when the tables are turned? What happens when you're the victim, and the person who hit you is another David, the one with bare bones coverage? Or worse, no coverage at all. This is the scenario that keeps insurance adjusters up at night. It's the single biggest trap in auto insurance. A financial black hole that can swallow your savings, your home, and your future in the blink of an eye. Because when you're staring at a totaled car and a mountain of medical bills, the terrible truth is this. The at-fault driver's lack of responsibility has just become your problem. You can sue them, of course. You can take them to court and win a massive judgment. But the old saying is brutally true. You can't get blood from a stone. If they don't have money or assets, that court judgment is just a piece of paper. It won't pay the surgeon. It won't pay your physical therapist. And it won't make your car payment. This is where your own insurance policy is supposed to step in and become your champion, but only if you've armed it with the right weapons. We're not talking about collision or comprehensive anymore. We're not even talking about your liability coverage. We are entering the world of the two most misunderstood, yet arguably most important, coverages you can buy: uninsured and underinsured motorist protection. Think of them as your personal financial bodyguards. They exist for one reason: to protect you from the financial fallout caused by other drivers who failed to get proper insurance. Let's start with uninsured motorist coverage, or UM. This one is pretty straightforward. Kicks in when the person who hits you has zero insurance. It also, crucially, often applies in hit-and-run situations, because if you can't identify the driver, they are treated as being uninsured. Now, UM coverage is typically split into two parts. The first is uninsured motorist property damage, or UMPD. If an uninsured driver destroys your car, instead of using your own collision coverage and paying your $1,000 deductible, you could use your UMPD. The big advantage here is that the deductible for UMPD is often much lower, maybe just a couple $100s. It's a nice perk, but the real heavyweight, the true savior in this scenario, is the other half: uninsured motorist bodily injury, or UMBI. This doesn't cover your car. Covers you, your body, your health, your ability to earn an income. Let's go back to Sarah. Imagine she's driving home from work, sitting at a red light, when a driver texting on their phone plows into her from behind. It's a serious crash. Sarah suffers a severe back injury and a concussion. The other driver, it turns out, let his insurance lapse months ago. He has nothing. Sarah's car is a write-off, but that's the least of her worries. She needs an MRI, weeks of physical therapy, and she's a freelance graphic designer who can't work if she can't sit at a computer for hours due to excruciating back pain and headaches. Her health insurance will cover some of it, sure, but she has a $5,000 deductible, and then 20% coinsurance on everything after that. The bills are piling up, and her income has dropped to zero. This is the nightmare. But Sarah was smart. On her own policy, she had $100,000 of uninsured motorist bodily injury coverage. That coverage now springs into action. It acts as if it were the insurance the other guy should have had. It will pay for her $5,000 health insurance deductible. It will cover her 20% coinsurance payments. It will compensate her for the weeks of lost income. It can even provide money for pain and suffering, recognizing the profound impact this crash has had on her quality of life. Her UMBI coverage becomes a financial lifeline, allowing her to focus on what actually matters: her recovery. Without it, she'd be facing medical bankruptcy, all because of someone else's mistake. Now you might be thinking, what are the odds of that? Most people have insurance. And you'd be tragically wrong. The Insurance Research Council estimates that 1 in every 8 drivers on the road in the United States is uninsured. 1 in 8. In some states like Florida, Mississippi, and New Mexico, that number is closer to 1 in 4. Every time you pull out of your driveway, you are sharing the road with millions of people who are one bad decision away from ruining you financially. Uninsured motorist coverage is not a luxury. It's a shield against a very real and very common threat. But there's an even more common, more insidious threat out there. It's not the uninsured driver. It's the underinsured driver. This is the person who did the absolute bare minimum. They bought the cheapest policy they could find, with state minimum liability limits. In many states, that might be just $25,000 for bodily injury. $25,000. In today's world of healthcare costs, that amount is a joke. A single night in the hospital, one surgery, one MRI can evaporate that entire limit instantly. This is where underinsured motorist coverage, or UIM, steps in. This is the coverage that protects you when the at-fault driver has insurance, but it's not nearly enough. Let's change Sarah's scenario slightly. This time, the driver who hits her isn't uninsured. He has a policy, the state minimum, $25,000 of bodily injury liability. Sarah's medical bills, however, come to $150,000. The at-fault driver's insurance company promptly writes a check for their policy limit, $25,000, and wishes her the best of luck. They fulfilled their legal obligation. But Sarah is still facing $125,000 in medical debt. This is where her own underinsured motorist bodily injury coverage saves the day. Let's say Sarah had UMBI limits of $250,000 on her own policy. Her insurance company would look at the situation and say, "Your total damages are $150,000. The other guy's insurance paid $25,000. That leaves a gap of $125,000. Then, her own insurance company would pay her that remaining $125,000 from her UMBI coverage. She is made whole again. Her own policy stepped up to fill the gap left by someone else's inadequate coverage. This is a concept that blows people's minds. You are paying for a type of insurance to protect yourself from the cheapness of other drivers. And it is, without a doubt, one of the best investments you can make. The difference in premium between having no UM/UIM coverage and having robust protection, say $100,000 or even $250,000, is often shockingly small. We're talking about a few extra dollars a month. The price of 2 cups of coffee to protect yourself from a 6-figure medical debt. The math is undeniable. So let's put all the pieces on the table. We have 4 core protective coverages. Collision and comprehensive are there to protect the value of your car. They rebuild or replace your physical asset. Then there's liability, which protects all your other assets. Your savings, your home, your future earnings, when you are the one who causes the accident. And finally, there's uninsured and underinsured motorist coverage, which protects your most important asset of all, your health and your financial well-being. When someone else causes the accident and can't pay for the damage they've done. Each one covers a critical and completely different vulnerability. They are not interchangeable. They are 4 pillars supporting your financial security on the road. So I want you to do something. Sometime today, pull up your auto insurance policy online or find that paper copy in your filing cabinet. Look at the declaration page. Find the lines for uninsured and underinsured motorist coverage. Do you even have it? Many people decline it to save a few bucks, not understanding what they're giving up. If you do have it, what are the limits? Are they just the state minimums? A measly $25,000? Ask yourself this powerful question. Look at your bodily injury liability limits, the amount you have to protect others. Maybe it's $100,000. Maybe it's $300,000. You decided that other people on the road were worth protecting up to that amount. Now look at your uninsured motorist limits. If you believe a stranger's health is worth protecting for $100,000, don't you believe your own health is worth protecting for at least the same amount? Now that you understand the what and the why behind these essential coverages, the entire insurance puzzle starts to become clear. But the final, most critical questions remain. How do you put it all together? How do you choose the right limits and the right deductibles for your specific situation? And how do you navigate the maze of insurance companies to find the best possible price without sacrificing the protection you now know you desperately need? Well, let's answer those questions. Let's build your fortress right here, right now. This isn't about guesswork. It's about a clear, logical framework for protecting your financial life. We'll break it down into 3 critical decisions. Decision number 1, the deductible dilemma. This is the first number you'll see, and it's the most straightforward trade-off in all of insurance. A higher deductible means a lower monthly or semi-annual premium. A lower deductible means a higher premium. It's a seesaw. So how do you pick your number? 500, 1,000, 2,000? Here is the single most important rule. Your deductible should never, ever be higher than the amount of cash you have readily available in an emergency fund. Let me say that again. Do not choose a $2,000 deductible if you don't have $2,000 you can access tomorrow without taking out a loan or selling something. Because when that deer jumps out or that hailstorm hits, your insurance company isn't going to write you a check for the full repair. They're going to write a check for the repair cost minus your deductible. That deductible is your ticket to getting the process started. It's the cash you have to bring to the table. Think of it this way. A $1,000 deductible might save you, say, $20 a month compared to a $500 deductible. That's $240 a year. That's real money. But if you have a claim, are you willing to pay an extra $500 out of pocket to have saved that $240? For some people with a robust emergency fund, that's a great bet. They're essentially self-insuring for that small amount and saving on premiums. For someone living paycheck to paycheck, a surprise $500 bill is a crisis. A surprise $1,000 bill is a catastrophe. Be brutally honest with yourself about your cash situation. Your emergency fund dictates your deductible. Period. Decision number 2. Choosing your liability limits. This is where people make the biggest, most devastating mistakes. They see the state-mandated minimums. Let's say it's 25/50/25, which means $25,000 for bodily injury per person, $50,000 per accident, and $25,000 for property damage, and they think, great, that's all I legally need. I'll take the cheapest option. This is financial suicide. State minimums are a joke. They were set decades ago and are woefully inadequate for the modern world. That $25,000 property damage limit? What happens when you slide on some ice and your Honda Civic glances off a brand new $60,000 Tesla, pushing it into a $70,000 BMW? You've just caused $130,000 in property damage. Your policy covers the first $25,000. Guess who's on the hook for the other $105,000? You are. And that $50,000 bodily injury limit per accident? What happens if the driver of that Tesla and the driver of that BMW both need surgery and physical therapy? Medical bills can skyrocket into the hundreds of thousands of dollars in the blink of an eye. Once your insurance policy taps out, the other party's lawyers won't just shrug and walk away. They will come for everything you own. Your savings account, your investments. They can garnish your future wages for years, even decades. They can force the sale of your assets. One bad accident with minimum coverage can financially ruin you for the rest of your life. So what are the right limits? Here's the rule of thumb. Your liability coverage should be, at an absolute minimum, enough to cover your entire net worth. Add up your savings, your investments, the equity in your home, everything you stand to lose. That's your starting point. For most people, I strongly recommend limits of at least 100/300/100. And if you have significant assets, a home, or a healthy retirement account, you need to talk to your agent about an umbrella policy, which is a cheap way to add an extra $1 million or more in liability coverage on top of your auto and home policies. Don't be cheap on liability. It's the shield that protects your entire financial future from a single moment of misfortune. Decision number 3. The value of your vehicle. This is where we finally decide if you even need collision and comprehensive anymore. This decision is all about your car's specific situation. The key concept here is actual cash value, or ACV. This is what insurance companies care about. It is not what you paid for the car. It is not what it would cost to buy a new one. Actual cash value is what your exact car, with its specific year, make, model, mileage, and condition, is worth on the open market the second before it was damaged. And thanks to depreciation, that number is always going down. So here's the calculation you need to make. First, go to a site like Kelley Blue Book or Edmunds and get a realistic private party sale value for your car. Let's say your 12-year-old sedan is worth $3,000. Now look at your insurance bill. How much are you paying specifically for the collision and comprehensive portion per year? Let's say it's $600 a year. The question becomes, is it worth paying $600 a year to protect a $3,000 asset? Maybe, but remember your deductible. If you have a $1,000 deductible, the absolute maximum your insurance company will ever pay out on a total loss claim for that car is $2,000, $3,000 ACV minus your $1,000 deductible. So now the real question is, are you paying $600 a year to protect a $2,000 potential payout? Now it starts to look less appealing. A good general rule is this. If the annual cost for collision and comprehensive is more than 10% of your car's actual cash value, it's time to seriously consider dropping them. But, and this is a massive but, you should only do this if you have enough cash saved to go out and buy another $3,000 car tomorrow if yours gets totaled. If you drop the coverage, you are officially self-insuring. You are accepting the risk. If you can handle that risk, you can save a lot of money on premiums for an older car. If you can't, you need to keep the coverage. And speaking of a car's value, let's talk about 2 critical add-ons related to this: gap insurance and new car replacement. If you have a loan on your car, especially a new car, you are likely upside down for the first few years. That means you owe more on the loan than the car's actual cash value. If you total that car, the insurance company will give you a check for, say, $22,000, its ACV. But if you still owe $26,000 on your loan, you are responsible for that $4,000 difference. You'll be making payments on a car that no longer exists. Gap insurance is a cheap add-on that covers that gap. If you are financing a new car, you absolutely need it. So now you know how to choose your deductibles, your limits, and your coverages. How do you navigate the maze of companies to get the best price? The single biggest mistake people make is staying loyal to one company for years. Insurance pricing is incredibly complex. The company that was cheapest for you 5 years ago is almost certainly not the cheapest for you today. You must shop your insurance at least once a year, or anytime you have a major life change like moving, getting married, or changing jobs. The best way to do this is to contact an independent insurance agent. Unlike a captive agent who only works for one company, an independent agent works for you. They have access to dozens of carriers and can shop the market for you to find the best combination of coverage and price. And when you shop, ask about discounts. There are dozens. Good driver discounts, good student discounts, discounts for bundling your auto and home insurance, discounts for having certain safety features in your car, discounts for taking a defensive driving course, discounts for letting the company monitor your driving through a telematics app. Never assume you're getting the best price. You have to ask. Let's put it all together. You are no longer just a driver. You are the risk manager of your own life. You understand that your deductible is tied to your emergency fund. You understand that your liability limits are a shield for your net worth, and state minimums are a trap. You know that collision and comprehensive are tied to your car's value and your ability to self-insure. And you know that the secret to a good price is not blind loyalty, but smart, regular shopping. Insurance isn't just another bill you have to pay. It's not a product you buy and forget about. It is a dynamic living shield that you must actively manage. It's the financial force field that stands between a simple mistake and total financial devastation. It's the mechanism that allows you to recover from the unexpected chaos of the world. It's the peace of mind that lets you get behind the wheel every day, knowing that you haven't just protected your car, you've protected your family, your future, and everything you've worked so hard to build. Now I want to hear from you. What's the one insurance lesson you had to learn the hard way? The one piece of advice you wish someone had given you years ago? Share your story in the comments below. Your experience could be the very thing that saves someone else from making a costly mistake. Protect yourself and drive safe.